It appears as if everything is fine. Inflation rates come back down, interest rates are somewhat predictable, and valuations keep on rising. But the issue is that this current situation is likely not going to last. When we zoom out a little bit and we look at where are we in the grand scheme of things in terms of traditional finance but also crypto, the picture isn't really that great. Now here are the long-term inflation rates in the US. And we've seen our massive spike after the COVID handouts. Now we are back down and we're currently at 2.7%. I think though that this picture is somewhat skewed because those are year-over-year inflation rates. I think it's better to look at this in a cumulative way. Have a look at this. This chart starts in February of 2020 and it sees the massive price increases after COVID. And yes, the inflation rates came down, but the price levels are not coming down, right? We simply just stay now at elevated levels. It is not getting easier, simply just the rate at which it gets harder is slowing down. But then there's also all this confusion around interest rates, right? We've got the inflation rates, how much are prices rising, but then we've also got the price of money, we've got interest rates. And the Federal Reserve raises interest rates whenever it believes it has to fight inflation, whenever it believes it has to shrink the money supply. And so here are the inflation rates and here are the interest rates laid on top of that in white. And of course, when inflation rates are very high at 15% or so, it does make sense to also raise interest rates. And then since 2019, we had zero interest rates. This was the time of cheap money. It was the best time to lock in a long-term mortgage. Then interest rates went up again, they crashed back down, and then because inflation rates skyrocketed, interest rates had to follow. But have a look at how much slower the reaction this time was. Inflation rates were already high for 2 years and only afterwards the interest rates followed. This is different to the past. In the past, the Federal Reserve had been way more reactive. And so in the last few weeks, the Federal Reserve has announced that it will become more hawkish again. In other words, that the interest rate cuts will stop. So a few weeks ago, the market was still anticipating that we fall to 2.5% within the next 12 months. But now the futures market is anticipating something very different. The most likely scenario is that we will be between 4 and 4.25% 1 year from now. So interest rates will be higher than what people anticipated just a few weeks ago. And this is bad for long-term government bonds. So have a look at this. This is Zeros. This is a long-term government bond ETF. And that went down in the last 20 days by 11%. If you've got your money in quote-unquote safe bonds, you just lost 11% in the span of 2 weeks. Now this is all common knowledge. This is the kind of information most people talk about. But deep down inside, we all know that all of that data is completely fake. The inflation rates are not real. Prices tend to go up much faster than what is officially stated. Now, not all prices go up faster, but for example, if you want to buy a house, or if you want to buy land, or if you pay for education of your children, or if you have to pay for medical expenses, the rates go much higher. The products that become cheaper over time, relatively speaking, that only increase with the inflation rate are commoditized goods, like say flat screen TVs. But when we look at goods and services that are not easier to produce over time, where we don't have efficiency increases over the years, then we really get hit by the monetary expansion rate. So not by the inflation rate, by the rate at which how quickly money is expanding. And that's then this chart here. This is the US money supply. This is USM2 and it's growing exponential with sometimes our little blips in the chart, but still we tend to trend upwards. And instead of looking at this on a linear scale, we can also have a look at this on a logarithmic scale. Then we can see how constant money is actually expanding. We expanded a bit faster during COVID, then it slowed down, but the overall trend is pretty clear. How quickly is this going up? It's going up by 6.8% per annum. So if we don't look at productivity increases, if we just look at how much on average do things actually get more expensive, it's 6.8%. It's not those 2.7% that official statistics want to tell us, because in here we've got all kinds of manipulation and things are getting easier to produce over time. And so when we know that the monetary base is actually expanding by 6.8%, 6.8% per annum, now we get a whole new lens on assessing different asset classes. For example, have a look at this. This is the S&P 500, but it's not your regular S&P 500 chart. This starts in the 1950s. It goes all the way to today, and we're dividing the S&P 500 by the money supply. So if there was zero monetary expansion, if the Federal Reserve wouldn't always devalue our currency, this is what the S&P 500 long-term chart would actually look like. Yes, over the span of 65 years, we still have growth, but that growth is only 47%. Now, the S&P 500 is a price index. It's not a performance index. So on top of just the price appreciation, we also have dividends, but on top of that, we also have taxes and management fees, etc. So if we say that the taxes and the management fees are pretty much equal to the dividends, then we're only left with the price appreciation, and then we don't see that much outperformance over all those years. We've got less than 1% per year. Now, I would argue that probably it's even less than that, because I believe that currently prices tend to be very, very high historically. Now, how can we measure whether or not stocks in the grand scheme of things are expensive? We can look at the prices relative to, say, the earnings, or we can have a look at the prices or the market cap relative to the GDP. Let's start with the earnings. What we've got over here is the Shiller PE ratio. So this is the price to earnings ratio of the S&P 500, and it's adding an average to this. It's a 7-year moving average, but again, this is roughly 150 years of data. And we do see a bit of an increase over time, which might make sense because there was also some kind of adoption curve over those decades, right? In the early days, not many people had stocks, so it was simply undervalued as a whole. But still, historically speaking, we are now very, very high. In the outperformance of the S&P 500 since 1960 to today, that coincided with the Shiller PE ratio more than doubling. So it was at 18 in 1960 and now it's at 38. So relative to earnings, stocks are now double as expensive. But at the same time, the S&P 500 outperformed monetary expansion only by 60%. So maybe long-term stocks can't really outperform monetary expansion. Maybe we even see a slight underperformance. Maybe we should actually go down by 50%, which would put us over here at relative valuation levels worse than COVID. So what we've got over here is the dot-com bubble, what we've got over here is the global financial crisis, and what we've got over here is the COVID crash. So looking at stock prices relative to earnings is one approach. Another approach is to look at the market cap of the entire stock market relative to the GDP. And that's called the Buffett indicator. And here we are at all-time highs. The stock market now has double the market cap of the US GDP, of whatever the US produces within a year. Now again, there is potentially an argument we made that this should go up over time because stocks are now much more global. The companies make their money not just within the US, but also outside of the US. So okay, getting a larger share of the entire global economy might result in this indicator to grow over time. But still, historically, we are very, very high. And over here, again, we've got the dot-com bubble. Over here, we've got the global financial crisis. And COVID was just a little blip in all of this. I'm simply just showing data, right? I'm not saying that we have to crash tomorrow, but I am saying that when we now buy stocks, and Bitcoin for that matter as well, we are now taking on more risk. I'll talk more about Bitcoin in a second. Here's one more stock-related chart that I find very important. This is the Nasdaq 100 relative to US money supply. So yes, over the years, technology stocks can grow faster than monetary expansion, but we are currently at very similar levels to what we had seen with the dot-com bubble, right? Where then technology stocks underperformed US money supply by 85%. What we've got over here is the Nasdaq 100 relative to the S&P 500. So how expensive are technology stocks relative to regular stocks? And again, we are at all-time highs. And again, technology stocks tend to outgrow regular stocks, which does make sense. They have more risk. They've got a better business model as well, right? They can scale easier and cheaper. And they can go more global as well. But still, in the grand scheme of things, I'm not sure if this is the best time to buy. Now let's look at the darling within the tech space, Nvidia. What is its valuation? The market cap is currently $3.4 trillion. Now, how large is that? US money supply is at 21 trillion. So Nvidia is worth as much as 16 16% of the entire money supply in the US. $1 out of $6 is the value of Nvidia. Or let's say it's how much the market is currently pricing Nvidia for. Is it really worth 1/6 of all of money in the US? I doubt it. Yes, there is some value in artificial intelligence, and Nvidia is positioned incredibly well for that wave. But will artificial intelligence really take over the world? The market is definitely pricing in the optimistic case. I believe that the realistic case is lower than we are currently at. Now, what does this all mean for Bitcoin? Here is what it means. What we've got over here at the top is a long-term Bitcoin chart. And we simply just have two curved lines over here that connect the tops relatively well and the bottoms relatively well. And if we scroll in here, one might make the case that the current risk relative to the potential reward is quite high. But let's forget about those imaginary lines, right? Because again, nobody knows if we will stay in this trend. Let's instead look at this here at the bottom. What we've got here is a correlation coefficient. This line here shows how much is Bitcoin moving in sync with the Nasdaq 100. So when Bitcoin goes up, does the Nasdaq 100 go up as well? When Bitcoin goes down, does the Nasdaq 100 go down? It looks at this effect over the span of 1 year, and it's called the correlation coefficient. So when the correlation coefficient is at 1, it means that the two assets move in the same direction at the same time. When it's at -1, it means that the two assets move in opposite directions. So -1 in this case means that Bitcoin went down, and at the same time the Nasdaq 100 or technology stocks went up. So in the early days, there was no real connection between the two assets, right? You could own both, and you've got some kind of a diversification effect within a portfolio. But we can see that in the last years, the correlation coefficient gets closer and closer to 1. The negative correlation tends to subside. We tend to get closer and closer to a coefficient between 0.7 and 0.9. In other words, on a 1-year time scale, the two assets, Bitcoin and the Nasdaq 100, tend to now move more in sync. And this kind of makes sense, right? Because more and more Bitcoin is now held by institutions. It held through the Bitcoin ETF. And so the large players simply see Bitcoin as a risk-on asset. It has a lot of volatility. And when people get spooked that the market might crash as a whole, they will also sell off Bitcoin. An effect that we've also seen during the COVID crash, right? First, it was the stocks that crashed, and then a few days afterwards, Bitcoin followed. So that was over here. But at the time, the correlation coefficient wasn't even that high yet. Now it's much, much higher, and it seems to be quite sustainable at these high correlation coefficients. So again, what does this mean for Bitcoin? If you believe that the technology stocks are now relatively high relative to money supply, relative to other stocks, and that stocks in general are pretty expensive right now, and when we also believe that technology stocks move now more in sync with Bitcoin, then the current situation isn't that great. Bitcoin has never seen a real crisis. Bitcoin started in January of 2009 over here during the global financial crisis. So that was here, right? This was when the Shiller PE ratio was at 14, or when the Buffett indicator was at 53%. Yes, there was the COVID crash, but again, the COVID crash was just a small blip. It didn't really change much. The worst case scenario for Bitcoin is that all of those long-term pricing models are still too optimistic, because what means long-term in Bitcoin history doesn't mean long-term in traditional finance. Maybe this chart with those imaginary lines is already too optimistic. Maybe we are going to fall below this lower threshold. And where is this lower threshold? It's currently at $36,000. And again, this could be, in the worst of cases, still be too optimistic. We might even fall below this if we get a real crisis. Something that we've seen in the 30s and in the 70s and during the dot-com bubble and global financial crisis. According to my YouTube statistics, most people that watch this channel are of similar age of me, right? Around the 40s. So you probably also started investing at similar times. In other words, you have lived through pretty much just bullish years. We've never really experienced a crisis. We've never really seen our wealth shrink massively because of some kind of real collapse. COVID was really nothing in the grand scheme of things. And so what I'm taking from all of this is not that we have to panic sell everything, that we have to sell our our Google stock and then we have to sell our Bitcoin. What I take from this is that it's very, very important to also have some kind of a hedge. It doesn't have to be a ton of money, but if it's maybe 10 or 20%, that's maybe in the self-used property, or that's maybe in gold or silver, or that's in something that's not correlated with the financial markets that much. If you've got 10 or 20% in something that's not risk on, I believe that's the minimum precaution that is justifiable in a market like this. I don't think it's wise to be 100% in technology stocks and in Bitcoin. And I also don't think long-term government bonds are that great. But I do believe that having some kind of allocation in something that's not too correlated, that's risk off, is important. Now I'm talking about these kinds of concepts in way more detail in the premium membership of this channel. Feel free to check it out. There is a video down below on the website, thebitcoinstrader.com. It's 7 minutes of length. If your wealth is not just a few $100, but you've got tens of thousands, maybe hundreds of thousands of dollars that you have to manage, then the premium membership will probably be valuable to you. So the link is also directly posted below this video as a pinned comment. If it's your first time over here, feel free to subscribe. I appreciate you exactly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video, or see you in premium. Cheers.